Good afternoon, and thank you very much for joining me. This is Briant Sikorski. I'm a wealth advisor with Stratos Wealth Partners. You should be able to see on your screen my biography and my portrait, my picture there. And to kind of summarize there, it says essentially that I'm a wealth advisor and also accredited asset manager and chartered retirement plan specialists, which are additional specialties in the areas of portfolio design and retirement planning and retirement plans. And I help my clients pursue their investment goals, and this includes business or personal and business retirement planning, education savings, first and second home purchases, catastrophic risk management, and estate planning and wealth management. I work with my clients to make sure that as an independent advisor, I can provide them with unique and differentiated investment solutions that may appeal to their individual interests and values, including stocks, bonds, and socially, morally responsible mutual funds and exchange-traded funds. I entered the financial services industry after a 20-year career in the venture capital, information technology, telecom, and automotive manufacturing industries. I hold a Bachelor of Science degree from the University of Michigan and a Master of Business Administration degree from Oakland University. Our topic today is the mid-year outlook for 2018. And this is a publication put together by my, quote, broker-dealer. As an independent financial advisor, I have my own business, but I need to have a place where I can obtain research information, deposit cash, make trades, and that's what LPL does for me. LPL is the largest brokerage firm for professional investment advisors in the country, with offices in California on the West Coast and South Carolina East Coast. So they published this publication called the Plot Thickens, or I should say the LPL Research Mid-Year Outlook 2018, the Plot Thickens. And its objective is to provide a guidance on how the return of the business cycle may unfold during the remainder of this year and beyond, along with some investment insights to help you navigate the twists and turns that may present themselves. Now, this is essentially a twice-a-year publication, so in January they will have the outlook for the year, and then usually around July, like right now, they'll have the mid-year outlook. I should also share with you that I have muted everyone to try to keep the best recording quality as possible, number one. And number two is this presentation is being recorded, and when it's done, I will upload it to my YouTube channel. So if you want to watch it later, and I'll show you at the end how to get there. You can watch this anytime. Okay, so you heard me mention the phrase, kind of fiscal policy as opposed to monetary policy, and the fiscal policy is really that type of initiative that is spurred on by government, and that's I guess particularly the White House and Congress, as opposed to the monetary policy by the Federal Reserve. These are two different methodologies utilized to at times stimulate or cool the economy, with the objective of creating that optimal balance between employment or unemployment and inflation. Now, most recently in the papers and on the news, you've seen perhaps concerns and what risks do investors face around trade, including the new tariffs and trade negotiations. President Trump and his administration have called for increases in tariffs, and this has really weighed on sentiment with the tax-related market gains tempered by the potential for higher trade costs. Some of what's occurring is likely a part of a negotiating tactic. Nonetheless, the threat of a trade war is real and can be disturbing to investors and businesses. We do believe that some perspective is in order when considering these trade risks. The size, as this chart shows us, the size of the fiscal stimulus from tax cuts and increased government spending should far outweigh the threatened import duties. Between the U.S. tariffs and China projected retaliation in particular, those costs are estimated at approximately $105 billion over the next year, on top of the $15 billion in steel and aluminum tariffs already announced. However, the U.S. fiscal policy tailwinds, and that was from the new tax code, it amounts to about $350 billion on this chart. So while there's the potential added impact of businesses bringing home foreign profits, the tariffs are also still subject to revisions as negotiations evolve, whereas the tax law is, some components are permanent. And so I guess the bottom line, we think the good should outweigh the bad, thanks to the benefits of fiscal policy, with a potentially greater impact on growth than even is currently anticipated. Turning to the economy, domestically, now that fiscal measures are in place, we expect the U.S. economy to reap those benefits and start seeing better growth. Globally, the economic growth outlook for emerging markets may outshine developed international markets. We believe that the global growth story will continue with an expectation of 3.8% GDP growth for the world economy, thanks to new fiscal policies and improved business vitality, as you can see here. We continue to expect the U.S. economy to remain a primary driver, aided by the anticipated higher growth trajectory of emerging markets. While Europe and Japan still, as was mentioned earlier this year, continue to lag. The primary risks include an unexpected rise of inflation, a substantial increase in trade friction or trade negotiation friction, or some aspect of a large policy, an unexpected policy mistake. And I know I just was reading in the Wall Street Journal recently about how we're hitting some of the highest GDP numbers and some of the lowest unemployment numbers that have been seen perhaps within the last, well, since the Great Recession of 2008. While manufacturing doesn't have the clout it once did in the economy as a whole, the financial performance of manufacturing firms still has a major impact on S&P 500 index earnings. In addition, the Institute for Supply Management Manufacturing Index, which measures whether manufacturers as a whole is expanding or contracting in the U.S., hit its strongest level in over a dozen years this past February. It would be easy to perceive the recent peak in manufacturing growth to be a negative for the economy, but even when you're past the peak, growth has been found to continue and to still continue in a steady fashion. History has also shown that a peak in ISM manufacturing does not typically mean the end of stock gains or that a recession is right around the corner. As shown here, on average, over the last 5 economic cycles, Expansions have continued for nearly 4 years following an ISM manufacturing peak, during which the S&P has cumulatively gained an average of nearly 57%. You may see in the paper or the news this concept of a flat yield curve. And so that's what this chart is trying to espouse, that the flatter yield curve doesn't necessarily mean a recession is around the corner. What a flatter yield curve means is that typically short-term maturity bonds will have typically a lower rate of interest that they pay than a longer maturity bond. But times can happen when interest rates are rising, measurably or falling measurably, or for some period of time, short-term rates can be higher than or the same as long-term rates, and that's considered a flat yield curve. An inverted yield curve is when short-term rates are higher than long-term maturity rates. So when considering the overall bond market, investors face several challenges, the combination of which may pressure bond prices over the next few years. Volatility in market interest rates has been accompanied by a flattening of the U.S. Treasury yield curve, where short-term rates have risen faster than long-term rates. This may eventually lead to an inverted yield curve, where shorter-term rates are above long-term rates. Historically, this has been a negative signal for the U.S. economy, often providing an early warning of an eventual recession. Yet in this circumstance, we believe that the curve flattening with interest rates rising rather than falling is a market signal pointing towards future growth. A look at the last 5 cycles shows that the average time it takes from a flattening yield curve, represented by a 0.5% spread between short and long-term rates, to a recession has been almost 4 years, with stock prices climbing by an average of 67% during that time frame, as we show here. Outliers have really skewed the average, but a median return of 21% is a helpful reminder for investors to maintain a longer-term outlook. Considering our recommendation for a more active approach to bonds, it's important to identify how different types of fixed income securities have performed in rising interest rate environments. As a reminder, we expect yields to grind gradually higher with periodic bouts of volatility, and we maintain our year-end forecast of 2.75 to 3.25 for the 10-year Treasury. Risks to our forecast include a meaningful upside surprise in inflation or growth, which could pressure rates even higher. So let's take a closer look at fixed income classes now. Bond market segments vary in performance during rising rate periods. Now we're going to take a look at a few of these segments now, which you can see listed on the chart. U.S. Treasuries. Within the sub-asset class for bonds, U.S. Treasuries tend to have the most interest rate sensitivity and historically have performed poorly during Fed tightening cycles. Though increased Treasury issuance to fund federal deficit spending, will accentuate this trend, an attractive valuation compared to other sovereign debt may support buying, which should help contain yields. Investment-grade corporates. Though investment-grade corporate bonds are also sensitive to a more aggressive Fed, Better economic growth is helping to contain the interest rate differentials or spreads to treasuries, suggesting investor confidence in their ability to service their debt. Also, to boost this confidence, corporations have gone to great lengths to maintain healthy balance sheets and tighten their income statements during these past several years. And this is evidenced by still low debt-to-earnings ratios. Perhaps more importantly, the contained spreads collectively indicate a lack of stress in credit markets. Municipal bonds, or munis. Higher quality municipal securities tend to hold up better than treasuries in rising rate periods, as their tax-exempt status historically attracts investor assets. Mortgage-backed securities, or MBS securities. While higher quality mortgage-backed securities have performed well in previous rising rate environments, they are not without their own risks. If rates move significantly higher, fewer homeowners will refinance their mortgages at those higher rates, leaving mortgage-backed security investors with longer maturities than expected, essentially locking in lower interest rates. High-yield bonds. For suitable investors, other areas of fixed income may enhance yield within diversified portfolios, including bank loans and high yield. With less sensitivity to rising rates, we believe high-yield corporate bonds remain attractive given the combination of income potential and reduced default risk, given solid economic growth prospects. Nonetheless, we encourage investors not to get too enticed by the higher yields, which can often mask other fundamental deficiencies for companies in this space. Throughout the increased volatility in the first half of the year, we've emphasized to investors that bottoming is a process. In other words, when the market does experience a correction, even as the catalysts for that decline dissipate, the recoveries can still take several months. We saw this in 2011 and 2015, and this year has been no exception. The second half of the year will also likely see the added potential headwinds of midterm elections, which have historically, and it's for Congress, which have historically provided the most volatility within the 4-year presidential election cycle. Because the president's party typically loses approximately 25 House seats during a midterm election, investors have historically struggled with the policy uncertainty leading up to these elections. Here we show that the good news is that stocks tend to bounce back strongly after midterm election year corrections, as the average decline of 16% is followed by a solid recovery from the trough at a rate of 32% over the ensuing 12 months. A concern for investors that has recently surfaced is whether the recent first quarter earnings season would prove to be, as they say, good as it gets. Despite widespread discussion of peak profits, the first quarter earnings per share growth of more than 25% year over year does not necessarily mean trouble is imminent. Even if it were to be the percentage EPS growth peak in the cycle. In fact, a look back at 6 decades of earnings growth peaks suggests that it typically takes about 4 years from a profit growth peak before the economy slips into a recession, as can be seen here. It is noteworthy that the S&P 500 gained an average of 59% during these periods between earning growth peaks and the start of the next recession. Given that we are in the later stages of the economic cycle with factors such as increased trade tensions and geopolitical uncertainty at play, we do expect greater volatility may be ahead. However, it's important to remember that experiencing these ups and downs is a normal aspect of our market environment. Overall, we continue to see the potential for economic and market growth in 2018 and beyond. This LPL Research Midyear Outlook 2018 is here to provide that insightful commentary to help you navigate through the remainder of the year. And so now what might be the most fun part, I guess, and that is to review what that means to you as an investor and what can you take away from this report. So this research report believes the following 3 themes will be key to the markets over the balance of 2018. Number 1, fiscal policy remains key to growth. With tax cuts, a more business-friendly regulatory environment, and increased government spending will likely support consumer spending, business investment, and corporate profits as key drivers in our economic and stock forecast. Looking at market peaks in context, LPL Research believes that we are starting to see peaks in several economic and market indicators. But given our current environment, that doesn't mean a recession is necessarily around the corner. Creating opportunity amid rising volatility. LPL Research expects greater market volatility ahead, but reminds investors that experiencing these ups and downs is a normal part of our market environment. Instead of fearing it, there is the potential to create opportunities by embracing it and strategizing accordingly. So the midterm report maintains confidence in the existing forecast reported in the Outlook 2018 back in January with some minor adjustments. Number 1, in the economy, the GDP growth will be 3%, will exceed 3%. Earlier this year, LPL Research slightly upgraded the GDP forecast as tax cuts could likely improve personal and business spending. LPL Research expects the combination of tax cuts, a new government spending package, and financial deregulations to support continued growth. Stocks. We expect strong earnings are still expected to remain the key driver of stock market gains, thanks to the benefits of the new tax law. Although volatility is expected to increase in the context of steady economic growth and strong corporate profits, LPL Research sees the potential for further stock gains in the second half of 2018, and they're expecting 10+% total returns. With regards to bonds, accelerating global growth and rising interest rates will continue to pressure bonds. The mid-year report maintains the forecast of flat to low single-digit returns for the Bloomberg Barclays U.S. Aggregate Bond Index, but notes that high-quality bonds may provide diversification benefits for investors' portfolios. So here now, based on those expectations, we take a look at our recommendations at a glance. And we see here at top of the list, investment ideas we can't stop talking about. Small caps, these are small companies which are beneficiaries of the lower corporate tax rate and their U.S. emphasis. Value, with relatively attractive valuations and rate environment, should help financials. Cyclical stocks, with accelerating growth, this may support economically sensitive sectors. Emerging markets with strong growth and attractive valuations, which should offset tighter monetary policies. Bank loans or their floating rates may benefit holders if short-term rates rise further. And investment-grade corporates with their added yield as opposed to treasuries makes them attractive, and we favor now intermediate maturities, those that are in the maybe 5 to 15-year maturity area. In the middle here we see recommended for you. They may not be grabbing all the buzz, but these ideas could be a solid addition to your queue. I don't know who came up with that word, but your portfolio maybe. And that includes U.S. stocks with accelerating growth and fiscal stimulus providing an edge. Mortgage-backed securities with yield relative to rate sensitivity being attractive, but slowing Fed purchases will limit their upside. And high-yield corporates with yields that are attractive despite in some cases reaching full valuations. Finally, save for later. These are investments that may not be at the top of your list this year, but you may not want to count them out when looking to develop a diversified portfolio. Those can include developed international bonds where accelerating growth and very low yields create little margin of error. Developed international stocks where European growth may have peaked while structural concerns still remain high. Long-term high-quality bonds offering inadequate compensation for added rate sensitivity. And U.S. defensive stocks with economic growth and rising rates decreasing their attractiveness. Those defensive stocks would be like utilities or oil and gas that are more of a steady earner, steady performer. And with that, that concludes this presentation. As I mentioned, I will be I've recorded this presentation, and I will be uploading it to my YouTube channel. And so here, you hopefully should be able to see what my website looks like. And this is at Briant, www.BriantSikorski.com. And when you go there, if you look up in the upper right-hand corner, you can see links to my Facebook, LinkedIn, Twitter accounts, and to my YouTube channel. And if you click on that, it will take you to my YouTube channel where you can see the other webinars that I have presented and recorded on topics like life insurance, healthcare and retirement, company-sponsored retirement plans, Social Security, and other tax cut related topics. So with that, again, I'll say thank you very kindly. Thank you again for joining me. I hope you have a great rest of your day, and look forward to my, you can go to my website again and at BriantSikorski.com, and if you click on the events tab, you can see here, these are where I will place any upcoming webinars that I have scheduled. So you can see my next one is August 21st, September 18th, October, November, December, on topics like long-term care, college, saving, financial planning in the face of dementia, aging, and financial implications, and finally that one on estate planning. So with that, again, thank you very much, and I look forward to speaking to you soon.